Welcome to our first lesson on derivatives. This is an introductory lesson where we look at specific types of derivatives and derivative markets. We start with the definition of derivatives, followed by a discussion on the structure of derivative markets. We shall have a quick introduction on the major types of derivatives before we go into detail later in the course. Let's get started. You should be familiar with assets and securities like stocks, bonds, and commodities. Derivatives are simply securities that derive their value from an underlying asset or security. In fact, the underlying may not even be an asset. Derivatives can derive their value from non-assets like interest rates, foreign currency exchange rates, and market indices. Even seemingly non-financial phenomena like weather can be an underlying for a derivative. There are various kinds of derivatives. We shall discuss forwards, futures, swaps, options, and credit derivatives for the Level 1 curriculum. Derivatives can be created and traded over a central exchange or over the counter. Option, credit derivatives, and futures are exchange-traded derivatives. This means that the participants trade over a central exchange backed by a clearinghouse. The commitments are standardized contracts managed by the clearinghouse. Exchange-traded derivatives are usually regulated. Forwards and swaps, on the other hand, are traded by dealers in a market with no central location. A dealer market with no central location is referred to as an over-the-counter market. The dealer marries the interested parties into a custom negotiated contract. Hence, the contract is with a counterparty, which exposes both parties to default risk. Over-the-counter markets tend to be unregulated. Derivatives can also be classified according to the nature of the contract. Futures, forwards, and swaps are considered forward commitment derivatives. Options and credit derivatives can be classified as contingent claim derivatives. A forward commitment is a contract where the parties are required to perform some action at a given time. A contingent claim consists of a payoff, which is only claimable if a particular event happens before the expiry of the contract. We shall go into an introduction of each of these classes of derivatives, which will explain why forwards, futures, and swaps are forward commitment contracts, while options and credit derivatives are contingent claim contracts. At the initiation of a forward contract, one party agrees to buy an asset from another party, not today, but on a specified settlement date in the future, at a specified price. This price is known as the forward price. By convention, the party who agrees to buy is called the long, while the party who agrees to sell is called the short. Neither party makes a payment at this point. The forward price is based on the current market price of the asset, also known as the spot price, adjusted by the cost of carry of the asset. We shall learn more about the pricing mechanism in a future lesson, so we'll leave it as that for now. Once the contract is initiated, it becomes locked in as the contract price. Over the life of the contract, if the spot price rises, such that the expected future price is above the contract price, the long will have a positive value, while the short will have an equal negative value. The opposite is true. If the spot price goes down, such that the expected future price is below the contract price, the short will have a positive value, while the long will have an equal negative value. What happens on the settlement date depends on what is specified in the forward contract. In a cash-settled forward contract, the difference between the contract price and spot price is calculated. If the spot price is higher than the contract price, the short has to pay the long the difference. Conversely, if the spot price is lower, the long has to pay the short the difference. Cash-settled forward contracts are also known as contracts for differences or non-deliverable forwards. Another form of settlement is known as a deliverable forward. In this case, the short is required to deliver the underlying asset to the long, and the long pays for it at the settlement price. Note that the price paid for the asset is the contract price, not the spot price. The spot price has no bearing in this arrangement. So if the spot price is lower than the contract price at settlement date, as in this case, the long is disadvantaged because it is paying a higher price than the market price for the asset. As mentioned earlier, forwards are over-the-counter contracts in which the agreement is between the long and the short. As such, both parties are exposed to credit risk as either party has the potential to default from the agreement. As the contracts are negotiated, they are usually non-standard to fit the requirements of both parties. Forward contracts also tend to be unregulated. In contrast, futures are exchange-traded contracts in which the agreement is with the clearinghouse. The clearinghouse does this by splitting each trade, acting as the opposite side of each position. It acts as the buyer to every seller and the seller to every buyer. This system allows either side of the trade to reverse positions at a future date without having to contact the other side of the initial trade. Traders will be able to reverse or reduce their position with ease. The clearinghouse also acts as the counterparty for each participant. The clearinghouse enforces rules like margins, which we'll discuss later, on the participants. This allows the clearinghouse to guarantee that traders in the exchange will honor their obligations. This guarantee removes counterparty risk from futures contracts. In the history of US futures trading, the clearinghouse has never defaulted on a contract. To facilitate trading, futures are standard contracts where traders either take the long or short position with standard sizes. Futures markets are usually regulated by the government. The fluidity of futures contracts makes them attractive to speculators who want to bet on changes in the price of an asset. Hedgers can also use futures contracts to reduce their risk exposure to the changes in price of an asset. For example, a transport company can buy oil futures to hedge against future increases in oil price. If oil prices do increase in the future, the company can sell the oil futures at a profit, which will soften the increase in operating costs due to increase in fuel prices. If the transport company wishes to take delivery of the oil or enter into custom contracts more suited to its needs, the company can turn to forward contracts instead. Besides these differences, there are three terms that apply only to futures. They are open interest, settlement price, and margin. The open interest of any particular futures contract is the total number of outstanding contracts that are held by market participants at the end of the day. Open interest increases when traders enter new long and short positions, and decreases when traders exit existing positions. Open interest is therefore a measure of the flow of money into the futures market. Some speculators look for trading signals based on the open interest for a particular asset. Settlement price is analogous to the closing price for a stock, but it's not simply the price of the final trade of the day. It's an average of the prices of the trades during the last period of trading, called the closing period. So as in this case, even though the final trade of the day was done at $88, the settlement price is recorded at the average price of the closing period, which is $76. This specification of the settlement price reduces the opportunity of traders to manipulate the settlement price. The settlement price is used to calculate the daily gain or loss at the end of each trading day. On its final day of trading, the settlement price is equal to the spot price of the underlying asset. Margin applies to futures contracts, but not forward contracts. Recall that under a futures contract, the clearinghouse is able to guarantee that all parties will honor their obligations. This is achieved through requiring both the long and the short to place an initial deposit known as the initial margin. The initial margin per contract is relatively low as compared to the size of the contract. For example, if a trader longs the futures at $100 at this point, an initial margin of $20 may be imposed by the clearinghouse. This initial margin is deposited in the trader's margin account. After the futures contract is obtained, changes in the price of the futures contract result in daily gains or losses. They are credited to or subtracted from the margin account of the contract holder. This is called the marking-to-market process. The maintenance margin is the minimum amount of margin that must be maintained in the margin account. If the balance in the account falls below the maintenance margin, additional funds must be deposited to bring the margin balance back up to the initial margin amount. So in this case, the trader has to top up his margin account by $24 to bring the account balance back to $20. Note that this is different from the case of an equity account, which requires investors only to bring the margin back up to the maintenance margin amount. Moving on, we have swaps, which like forwards are over-the-counter forward commitment derivatives. Swaps are like forwards in many ways. Recall that forwards typically require no payment by either party at initiation, are custom instruments where the contracts are non-standard, are largely unregulated, and expose both parties to counterparty risk. All these are true of swaps as well. In fact, swaps can be viewed as a series of forwards. Let's say these two parties want another exchange at another date on the same terms. They can initiate another contract with a different settlement date. Alternatively, they can enter into a single swap agreement where they exchange payments at the two settlement dates. A swap is defined as a contract whereby two parties agree to exchange a series of payments on periodic settlement dates over a certain time period. The contract ends on the expiry date, which is usually the date of the last payments to be made. At each settlement date, the two payments are netted so that only one payment is made. So in this case, green has to pay red a net payment of $10. The party with a greater liability makes a payment to the other party. You may ask, what's the point of swaps? To illustrate, let's use an example of paying interest rates on a loan. The Green Party may want to take a loan of $1 million, and for some reason he is offered a favourable fixed rate of 5%. However, Green prefers to pay a floating rate instead. The Red Party also wants to take up a $1 million loan, and for some reason he is offered a more favourable floating rate. However, Red prefers to pay a fixed rate instead. So what both parties can do is to take up their respective favourable loans and enter into a plain vanilla interest rate swap with each other. This is a simple swap where one party makes fixed rate interest payments on a notional principal amount in return for floating rate payments from the other party. So in this case, the notional principal may be $1 million. At each settlement period, Green pays Red floating rate on the notional principal. Green is called the floating rate payer. In return, Red pays Green the fixed rate on the notional principal. Red is known as the fixed rate payer. Both parties can use what they receive to fulfill their respective debt obligations. So if you examine this carefully, Green is paying floating rate as he desires, while he is actually having a fixed rate loan. Conversely, Red is paying fixed rate while he actually has a floating rate loan. In actual implementation, the party that has the greater liability shall make the net payment to the other party. So if the floating rate is 6% for this first settlement, Green shall pay Red the 1% difference on the notional principal. Besides interest rate swaps, other common types of swaps include currency swaps and equity swaps. These will be introduced at level 2. Moving on to contingent claim derivatives, we have options and credit derivatives. We've learnt that for forward commitment derivatives like futures and forwards, the long is contractually required to buy the underlying asset, and the short is similarly required to sell on settlement date. Contingent claim derivatives, on the other hand, give the long the right to buy, but not the obligation to buy at a given price. For options, this price is known as the exercise price or strike price. What's different here is that the long can choose not to exercise the option to buy if the conditions are not favourable. However, the short is still contractually required to sell at the exercise price, given that the long exercises the option to buy. The example we have given here is that of a call option. The owner of a call option has the right to purchase the underlying asset at the exercise price for a specified time period. The buyer of a call option buys this right by paying an option premium to the option seller. By convention, the buyer is termed the long call and the seller the short call. The opposite of a call option is a put option. The buyer of a put option has the right to sell the underlying asset at the exercise price. For a specified time period, the buyer of a put option buys this right by paying an option premium to the option seller. By convention, the buyer is termed the long put and the seller the short put. American options may be exercised at any given time up to and including the contract's expiration date. European options can only be exercised on the contract's expiration date. An easy way to remember this is that A stands for any time and E stands for expiration date. At expiration, an American option and a European option on the same asset with the same strike price are identical. They may be either exercised or allowed to expire. Before expiration, however, they are different and may have different values. We'll discuss the difference in a later lesson. An option fulfills the definition of contingent claim where there is a payoff, claimable if a particular event happens. The payoff here is the profit, and the event is when the market price of the asset is in the favour of the long, as compared to the exercise price. Credit derivatives, like options, belong to the class of exchange-traded contingent claim derivatives. The payoff here is a payout that compensates the owner in the event of a downgrade or default by a named borrower. The most common type of credit derivative is the credit default swap, or CDS. It can be likened to an insurance contract against default. A bondholder pays regular premiums to a credit protection seller. If the bond issuer defaults, the bondholder receives a payout that can compensate for some of the financial loss from the default. Another type of credit derivative is a credit spread option, in which the underlying is the credit spread on a bond. This spread is the bond's yield spread relative to a benchmark. A bondholder typically pays a premium to buy this call option to be compensated if the bond's credit quality decreases. The bondholder chooses the strike level of the option. When a bond's credit quality decreases, its yield spread will increase. At expiration of the call option, if the yield spread is above the strike, the bondholder will collect a payoff based on the difference. This payoff compensates the bondholder for the drop in market price of the bond. And that concludes this first part on derivative markets and instruments. Note that this is just introductory material, so certain concepts may only have been briefly mentioned. In subsequent lessons, we shall go further in depth into each of these instruments, particularly in the area of pricing. See you again.